Good evening, everyone. Thank you so much for joining us today. My name is Porfirio Coronado, and I'm with Dallas Area Habitat for Humanity. And today we have our two amazing counselors, Christian Marquez and Ms. Rita Higgins, that we are all going to be co-teaching today for making sense of credit. So it's a topic that a lot of you all are very interested on. So it's going to be a lot of information that we're going to bring today. Today's topic, it is being recorded in the case that you would like to share with your friends and family. It's good information. So feel free to share with them. And then, so we're going to be presenting on that. Again, thank you for joining us. Get your margarita ready because it is National Margarita Day. So I'm not judging. I mean, I might have my own over here. So yes, thank you so much for joining us. And Rita, Christian, how are you doing?
Doing pretty good. I'm excited about the class. Like I said, we know this is a subject that everybody is interested in. So happy to be presenting for everyone.
Yes, good evening. Glad to be here. Hope you guys are getting ready for that cold front we're supposed to be getting. So definitely enjoy your margaritas because it's going to get colder this second part of the week.
Yes.
All right. Christian, you're up first.
Good. You can share screen? All right, guys. Thank you guys for joining again. Again, today we're going to be talking about making sense of credit, how credit scores and are the GPAs of adulthood, right? We're going to be making sure we are aware of how credit score works and the credit report and kind of getting into details about why is it important and then, how can you improve it or work on making sure that you keep it at the level that we want to keep our credit score. So again, today's agenda, we're going to be talking about credit reports. We're going to be talking about understanding your credit score, like what credit bureaus are reporting, what credit agencies, and then of course, what factors determine our credit score. And I'm a big believer that your credit score is pretty much a summary and the credit report is the full book. So we're going to be talking about that, stuff like that, and also establishing credit and improving your score. We're all young. Some of us are younger than others, and some did have some mistakes growing up. So definitely, that doesn't mean that we cannot fix our credit. So that's going to be something we're going to be talking about today in our workshop. So thank you guys for joining. Now let's get started. So we're going to have a poll. So we have a quick question. Okay. So definitely participate. We hope you guys can give us some feedback. And of course, don't be scared. We'll give you guys about a minute. So the poll question number one is, a credit report is open for you when you get a social security number. So is that true or false? Go ahead and click the answer that you believe is correct. Again, we won't know who picked what. So definitely just going to be for our eyes only. Again, the question is, a credit report is open for you when you get a social security number. Is that true or false? We'll give you guys another 30 seconds to 45 seconds to, answer the question. Don't be shy. Right. Thank you guys all for participating.
All right, Christian. So it looks like our audience are 50-50. 45% say that it's true.
Okay.
That a credit report is open when you have a social security card number.
Okay.
55% says false. So what do you think?
So I'm gonna go with Ms. Jackson. Ms. Jackson says that I know that's right. She said, yes, but it doesn't generate a score until you are 18. And so the answer is false. So you do not get your credit report when you get a social security number. You actually start receiving a report once you start building credit. So usually that's the age of 18. Now, some people, sorry guys. Hi, my love. Some people that do not get credit cards or get any type of student loans or auto loans or even a home at 18 actually don't build their credit until the age of either 20, 24. So it just depends on when you're establishing your credit. So, that is a myth. Some people believe that once you have a social, you start building credit. or get a credit report, and that is not true. Thank you guys for participating in the poll. And a little gem. So yeah, most people start building their credit at 18, but if you are aware of some financial literacy, you actually can also build your kids' credit or family members' credit before the age of 18 if you add them as an authorized user. So that's something you guys can take, share with your family and friends. Definitely, we want to make sure that the credit card you add in as an authorized user is good when it comes to, you know, utilization, good payment history, not high balances. So that way they're building credit. But yes, that's a gem. So what is a credit report, right? A credit report is a statement that has information about your credit activity and current credit situation. Like I mentioned earlier, whenever we're adding people to the credit cards, you know, they're under the age of 18 and you want to have them ahead of the curve at 18, you want to make sure you have a credit card that has good payment history. You know, payment history is important because that shows that you're making monthly payments and you are being responsible of how they pay it. And so that's something that on your credit report is showing, right? Like I mentioned, the credit report is the full book that you're reading, and the credit score is more of the summary of what's going on. And of course, you know, lenders use these reports to help them decide if they will loan you money, right? You know, you can say, hey, we make this much money, hey, I have this much saved in the bank, but lenders want to know the risks. They want to know, okay, if I'm giving her, you know, $100,000 for this home, are they willing to pay me back? Am I going to have to worry about a default or foreclosure? So they use your credit report to see the history based off of utilization, you know, inquiries, how new your credit is, how long you had credit, and of course, how you did it with those payments that you're supposed to be making every month. And of course, we're going to talk about what information do credit reports contain. So we went over a few, but we're going to kind of get more into details of what's all included in your credit report. So of course, we're going to say, what is a credit score, right? It predicts how likely you are to pay back money you borrow on time. It's usually a 3-digit score. It can range anywhere from 300 to 850. And depending on what your lender or bank you use to get that type of loan or line of credit, there's different types of methods. Most people are aware of the FICO scoring system and also the Vantage. So it just depends on what you are doing and what are you looking for type of line of credits. A lot of times too, people are not aware, but when you get an auto loan, a lot of companies use what's called the FICO auto loan score, which is different from your home loan and credit card company loan numbers that they use. So this is important to be aware of. Again, FICO and Vantage are the two most the two used for when it comes to generating your credit score, and lenders use, depending on what they are looking for, what type of line of credit, one of these two scoring methods. So we want to talk about why is this important, right? This is important because, like I mentioned, this is going to show the lenders how likely you are going to pay it back, and this will in turn show, okay, how much they're going to charge you for interest, right? Since they are letting you borrow money, they want to say, okay, you know, we're going to get our money back, but how do we make money? So that's when it comes to interest and APRs, and you know, so if you borrow money, okay, how much am I going to get out of it if I let you borrow $1,000, right? And that's where we're looking at, you know, credit cards run from anywhere between 12 to 22%. And, you know, currently right now with home loans, we had low interest rates, low as 2.2% to around on average right now 4%. So your credit score determines a lot of how that is being set. So definitely just be aware about that and kind of make sure you are aware that a credit score is that 3-digit number, and that credit report shows everything that's going on. You know, credit report also holds your personal information. It holds, you know, all the accounts you have, anything that might be in collections, anything that might be charged off, anything you might have paid off, and of course, any public records, and of course, access to your rights, and the 3 credit bureaus, which we're going to talk about, Equifax, Experian, and TransUnion later on. So you may have different credit scores, right? And it's normal to see slightly different numbers. And the reason why is, as you can see, is because every credit bureau has different ways of ranking your credit score. So for example, you might have a 726, a 698, and a 711 score, right? You saw your credit score online, which provided it from your credit card company. And that's why you might see a 726. You sign up for a separate free credit monitoring service, or you might have got something through one of your credit card companies or your banks that offer like a journey credit monitoring system or whatever the case might be. And that shows a different score. That's where we see that 698. And then of course we have your auto lender, which shows your credit score is used to validate your auto loan application. Now we mentioned, right, there's a different score for when you're getting loans for either auto loans or even home loans. So those things, even though you're the same person, they have different scores depending on what type of line of credit you're looking at. And of course, this credit report data, its score is used to report to the companies, and each of them may have different information, different data, right? Some might say that you collected on the 1st, some might collect on the 15th, depending on where it is. A big factor as well as timing, not calculated on a fixed schedule, right? Experian, they might collect their data from all the lenders on the 1st of the month, whereas Equifax and TransUnion might collect it towards the end of the month, depending on, and also you might see that your payments are all out through the month. So depending on how you're paying your bills, that also determines a fluctuation of how your score is different from one to the other. And then of course, we mentioned scoring models. There's multiple versions for scoring models. Again, the two biggest ones are FICO and the Vantage score. So just be aware that, you might be seeing more than one and it's okay, but we want to know a ballpark where your credit score is. So you kind of can be aware of, okay, what I need to work on, or if you have good or decent credit. So who generates these scores, right? Who's telling me what scores I have and who doesn't, right? So we have the three main credit bureaus when it comes to personal credit, and those three are Experian, TransUnion, and Equifax. Now you will find their information here on our slideshow. Sorry, we went one page up. You can see here, you're gonna see all three. Now, if you guys have pulled your credit report in the past, we can get your free credit report once a year from 3 credit bureaus through annualcreditreport.com. We'll add that in our chat right now for you guys. But when you get your report, in the bottom of the report, it shows these 3 credit bureaus and their information, how you can reach out to them. And of course, you have their website and then of course their phone number. Now, when it comes to getting a home loan, you're going to hear about what's called the tri-merger credit reports. Now, these reports include scores from all 3 agencies, and they're used by mainly all lenders and always for a mortgage lender, right? And what happens is, since you do have 3 different credit scores, they usually go with the one in the middle. They don't go with the best score or the worst score. They go with the one in the middle. And that's what we usually call a tri-merger credit report and credit score, because that's how we figure out, okay, that's the number we want to go with, is a ballpark. We average it out, we got rid of the worst and the best. And that's why we go with that one in the middle. So again, it's not an average. It's just pretty much out of the 3, what is your middle score? And that's what they use when it comes to getting a home loan. All right, so what makes up a credit score? This is something really important. A lot of people don't know, okay, well, I know I need to work on my credit. I need to have type of credits, but how do we determine this credit score, right? And so the biggest factor of your credit score is payment history. That's 35% of your credit score. So we can control our credit score and work on making sure that it's great if we just pay bills on time. So again, as you can see here, payment history is 35%. The second thing that weighs the most is current debt. And as you can see, that in the payment history alone is over 50%, it's 65% of your credit score. So current debt means anything that you have on your line of credit, so your utilization. So if you have a $1,000 credit card and you have a balance of $800, that means your current debt is gonna make your score a little bit lower because you have high utilization. Because you're using a lot of your credit, that 30% of your score is gonna be pulling it down because you're using high utilization. Whereas if you have a current debt of under 30, the magic number is 30% of utilization or less. I always say the under 10% better or no debt at all. But definitely, as you can see, current debt is 30%. And then of course we have length of credit history. So that's the time you have credit, that's 15%. And then of course we have types of credit. That's, pretty much the full diversification of either auto loans, student loans, any personal loans, credit cards, and of course a mortgage. The types of credit, making sure it's diverse, that actually is 10% of your credit score. And then we have your new credit, right? That's when you talk about inquiries or running what we call hard pull or soft pull. That's 10% of your credit score. And so you can see broken down, these all equal 100%. And so it's broken down based off what you're doing when it comes to your credit score.
Christian, I'll take it from here.
Sounds good.
All right, so now that Christian explained to you what makes up a credit score, so now let's get into detailed. Okay, so as he mentioned, that your payment history is basically the majority of your credit score. So whenever they're looking at, lenders are looking at your payment history, they want to learn, will I get this money back? Okay, so if they let you borrow money, will they get it back on time? Okay, so the factors on that is like, they want to learn, have you paid your bills on time? Okay, and if you have paid them late, how late have you paid them? Has it been like 30, 60, maybe 90 days, or has all gone all the way into collections? Okay, do you currently have an account in collections? Okay, are they in collections within the last 3 years? Okay, again, because the more recent, the more effect it's going to have on your credit score. Okay, now they're also going to look at charge-off accounts. Okay, a charge-off account is basically an account that the lend or the creditor is no longer seeking, and they have written off of their accounting books, but you are still liable to pay that account back. Okay, they just are not actively seeking it, but at any time they could always reactivate it and start seeking that money back. Okay, and of course there's bankruptcy. Okay, bankruptcy decreases your credit score drastically. So if that's something that you are considering, I highly suggest for you to speak to a professional, because there's two types of bankruptcy. There's a Chapter 13 and a Chapter 7. Okay, and each of them have different implications when applying for a mortgage loan. Okay, and of course you have judgments, and then you also have foreclosures. Okay, so again, foreclosures also affects your credit score drastically, and will affect on how the type of loan that you will be getting in the future, as far as like a mortgage loan. Okay, now what is paying bills on time? Okay, it is in bold or it's in capitalized letter for a reason. Okay, paying bills on time is equal to the most positive impact on your credit score. Again, paying bills on time is the best, the most positive impact on your credit score. Okay, so what we're trying to say with that is that continue to make your payments on your accounts that you have on credit right now on time. That way you have a positive credit score. Okay, and when we say positive credit score, we are referring to a credit score of at least 620, over a 620. Okay, even though that right now you are able to qualify for a mortgage loan with a credit score of at least a 580, but at a 620, 640 credit score, you will have a better loan options. Okay, now as far as like paying bills on time, now late payments, accounts and collections, and charged off accounts, that has the most negative impact on your credit score. So you never want to have those late payments, accounts and collections, and charged off accounts. Okay, because again, that has the negative impact on your credit score. Now, if those late payments, charged off accounts, and negative impacts is very recent, that has a higher impact on your credit score. Okay, because again, because payment history is 35% of your credit score. All right, now what about current debt? Again, that's the second chunk of like the majority of your credit score is worth. Okay, so in this, lenders are asking what is your capacity? Okay, now whenever they look at your capacity, they're looking at different factors, the balances versus the limits. Okay, what is your current balance versus the limit that you have to spend on this account? Okay, the more you go towards that limit, or the more that you charge your account to that limit, the lower your credit score is going to be. Again, because you are now a higher risk. That means that you have a need of money, a need of cash. Okay, so that has a negative effect on that. So you never want to have your balances close to your credit limit. Okay, you always want to have your balances between 50 to 30% of your credit limit. Okay, also your capacity also shows the debt to income ratio. Okay, I want to see on the chat, what does the debt to income ratio mean, and why does this matter? Anyone? Well, I will start calling someone. Okay, I'm gonna start calling someone. And you can just put it on the chat. I'm not gonna put you on video or anything. All right, Veronica, let's see. What is the debt to income ratio? Just put it on the chat. Someone just, okay, Barbara, she said the amount of debt compared to the amount of income you have. Marquita says the debt to income is the amount of debt that you have overall, your overall income. The amount of debt, yes, everyone's correct. Yes, so the debt to income ratio is the percentage of your gross monthly income that goes towards the monthly payment or your monthly debt payment. Okay, so typically your debt, you don't want to exceed your debt overall, especially whenever you're thinking about purchasing a house of 43%. Okay, because that 43%, it says that based on your gross income, you could afford at least 43% of your debt on credit. Okay, so that's what that means. Thanks so much for it's okay, Veronica. All right, so what about the length of history? Lenders are asking, can you show the long-term credit worthiness? Okay, on this, the factors that they're looking at, this is how old is the oldest account. Okay, and the older the accounts you have in good standing, the better, because you have a longer credit history than those people that are just now starting to have credits. Okay, the average of they're also looking at the average of ages of all accounts. Okay, now long history is good only if it's in good standing. Okay, so you just because you have an account that you opened in when you were 18 years old, but that account's it's in collection, you know, that is not giving you good credit history. You know, it has to be in good standing. Okay, so pro tip here, leave your credit cards open with 0 balances, even if you do not use them. Okay, because if you use them, you will lose that credit history. Okay, so if you leave them in 0 balance, you can maintain that credit history associated to that account. Okay, so for example, a lot of times clients or you might have a credit card that you don't use, and your lender or your creditor is going to close it, but they'll send you a letter or an email saying like, hey, we're about to close this letter, or there's a card because we see that you don't have any activity on it. Then you know, I suggest for you to just go ahead and go charge it and buy something with it. Okay, but you always want to leave them at 0 balance, even if you're not using them. Now, the types of credit. Now, on this aspect of the credit score, lenders want to see, can you manage different types of credits? Okay, now when they look at this, they're looking at what credit have you used? Do you have credit cards? Do you have a car loan? Do you have student loans or a mortgage loan? You know, the better you can manage different types of credit, the more credit worthy you are. Okay, just a note, for example, for those that are in like the home buying process, after you close on your house, then a lot of times you will start receiving car loan offers, credit card offers, because they know that you know how to manage your credit better because you now have a mortgage. Okay, but don't fall for it. Okay, you always want to again, you always want to be mindful with that. Now, pay attention to this. The types of credit is a small component of your account. Okay, so simply to just mix up credit types. Now, what we mean about this is that if you are in the home buying process, don't go and go get a car note just because you want to have different types of credit, right? Or you want to go get a credit card because you don't have a credit card, you don't have a car note on your credit right now. This is a small component of your credit. Okay, so whatever you have right now in your credit, keep it that way. Okay, because again, this is just a small component of it. So this is not a big, it's better for you to pay it on time, whatever you have right now, just to pay it on time, because this is a small component of it. And I'm trying to say that over and over, because I don't want you all to, like what Porfirio said on the meeting, that I needed an auto loan and I only have a credit card, so let me go get a car note. No, that's not what I said. It's just a small component. So, whatever you have on your credit right now, just keep it that way, okay? And if you're in the counseling program, ask your counselor, ask Aretha, myself, or Christian to say like, hey, do I need to have different types of credit? Again, new credit. On this new credit, lenders are asking, what is your cash flow like? Okay, applying for new credit means that lenders do a hard pull. Okay, what is a hard pull? Meaning that they're going to pull your credit report or your credit score or your credit history as an inquiry. Okay, now when they do that, that will result in the decrease in your credit score. Okay, if you go out and ask for new credit, okay, this indicates that you are in need of cash, because otherwise you would have paid that with your with actual cash, with your debit card or stuff like that. So what I'm trying to say here is that you will see a lot of times that if you go apply for like a credit card at a clothing store, and then later on you go to another clothing store and they also offer your credit card. If you got accepted for the first store, chances are that the second store would deny you, because now you're like, okay, this person is in need of cash. Like, otherwise, why would they be asking for credit in both stores? Okay, so be mindful of that. Oh, we are off to our next poll. And let's see. All right. Now, the question that we have is, paying off outstanding balances of a past due account removes any information from your credit reporting, indicates that the accounts have been ever past due. True or false? So if you paid off something, would that show that you never owed them at any time? Is that true or false? We have 22 people here. We have so far about 10 people that have answered, so I need a little bit more participation here. All right, we have at least, all right, we have 15 more seconds. Cast your vote. Well, there is a right or wrong answer, but it is anonymous, and that's what we're here for, to learn. So don't be afraid. If you don't know, just choose something. Awesome. Let's see. So the correct answer is false. Okay. Because again, it's still going to show that you at one point you had a past due account. Okay, and it's going to remain in there at least for 7 years. Okay, and Aretha?
All righty, next slide. We're going to talk about the importance of good credit and why it's important to have good credit. All right, first and foremost, interest rates. All right, so if you have a low credit score, guess what? That means that you're going to be charged higher interest rates. So it's very important, which is very costly to you, by the way. So it's very important that we work on getting those credit scores up higher so that you don't, have expensive loans and auto loans, home loans, and things like that. Also, employment. Yes, there are some people, when you are getting hired, they want to check your credit, especially, like I said, if you're working in finance or at a bank or something like that, they definitely want to pull a credit report. So it's important that you have a good credit score so you're not denied a job, so you can support your family. You also will have credit pulls whenever you go to lease or rent an apartment or a vehicle. So again, very important that you have good credit so you don't be denied these things, the necessities in life. Establishing utility services. Yes, they do pull a credit report. And if your credit is not where it needs to be, a lot of times you have to put down a security deposit, or you may need somebody to co-sign to even get your electricity turned on. And that can be embarrassing. So you want to try to make sure you have your credit where it needs to be. Insurance rates. I know a lot of people don't think this, but yes, they will pull your credit. And they look at that and they determine how much they're going to charge you, how much your premium is going to be every month because of your credit score. So having a good credit score is very essential to just surviving in today's world. Okay, ordering your credit report. I'm not sure how many of you know, but you can go every year and you can get a free credit report from this website here. So if you don't know that, make sure you're writing this down. It's www.annualcreditreport.com. So say as soon as this webinar is over, you go pull your credit report. You can get another free one next year, same time, same day, same time. Okay. You also have the Fair Credit Reporting Act provisions. First, I just like to say what the Fair Credit Reporting Act is. It was designed, to protect information collected by consumer reporting agencies, such as the 3 credit bureaus, medical information companies, and tenant screening. And some of the provisions of the Fair Credit Reporting Act, and I'm not going to go through all of them because there are quite a few, but I want to, go over some of the ones I feel that are really important. First and foremost, you have the right to know what's in your credit file. You have the right to request a credit score, but just remember that credit scores, you usually have to pay for those, okay? They don't come. Like if you go to annualcreditreport.com to get your credit report and you request the scores, you're gonna have to pay for those credit scores. You also have the right to adverse action notice if a creditor denies you financing because of something in your credit file. That's your right. So if you apply for, say, like a credit card, and maybe a week later you get a letter in the mail saying you were denied, it should have down there who you can contact, the 3 bureaus down there, and you can contact them and request a free copy of your credit report, and it'll tell you why you were denied for this loan. Okay, but you're also getting the credit report to see what's in your credit report as well. What could be causing you to be denied? Another one, you have the right to seek damages for violations of the Federal Credit Reporting Act. So you have, as a consumer, you have the right to sue if something, if you feel like you were violated against, something negative in your credit report that could possibly have hurt you financially. There are restrictions to who can look at your credit report. No one can just go willy-nilly and just say, hey, I want to read the Higgins credit report. They can't do that. Pulling your credit report is kind of like a need to know basis, okay? And also, before anyone pulls your credit report, you have to give them permission to. That's the next one. You have consent requirements. If anyone wants to pull your credit report, even an employer, just because your HR might have your social security number, that does not mean that they can go pull your credit report anytime that they want. They have to have your permission to do that. And just, again, keep in mind that a lot of these reports and things, they do not include the credit score. And due to COVID-19, up until April 20th of this year, you can get free weekly credit reports from all 3 bureaus. So there's no excuse for not having a copy of your credit report. Again, free from each bureau, Experian, Equifax, TransUnion, weekly, okay? So make sure you're taking advantage of that. We also have the types of accounts, okay? Some accounts are called in an individual account, this is just when you open up a credit card or something like that, and you're just listed on there. That's considered an individual account. You also have the joint account. Say you and your spouse, or you and your mom or something, you open up a card or something together, or you've applied for a loan together. That's considered a joint account. Okay, both of you are responsible for that account. And the next one is an authorized user. And an authorized user is just that you're borrowing somebody else's good credit. Okay, say you're just establishing credit. You don't have much credit, and you go on with your mom who has excellent credit, and she provides you a credit card that's in her name, or you may even get one in your name. You're not the primary person on the account, but you're an authorized user, meaning you can use the card if the person has stated that you can. All right. This is a good way, as we mentioned before, to build credit if you don't have credit. And then the different types of payments. You have the installment account. This just involves a set amount that's borrowed, a set monthly payment, and a set time frame. Common forms of installment loans, or just, like your home and auto loans. You're paying on that every month until it's paid in full. And then you have the revolving accounts. Revolving accounts allows you to borrow up to a certain amount. The borrower revolves the balance by rolling from month to month until it's paid in full. Types of revolving accounts are just like your credit cards, your store cards, your gas cards, things of that nature. And then you have the open 30-day accounts. And this right here is just a rare form of credit, and many people won't ever see it on their credit report. Okay, it refers to accounts that you can borrow up to a maximum amount, but you got to pay. You got to pay it back in full every month. So if you charge $1,000 on that, so next month when that bill comes due, you got to pay $1,000. But again, like I said, the open 30 days, those are very rare. Okay. Next slide, please. Oh, before we go, let's talk about the impact of co-signing for credit. And I want you to put in the chat, what does co-signing mean to you all? Does that mean that you're responsible for, say, okay, you have a family member and they ask you to, because they don't have good enough credit to go out and get a car loan themselves, and they come to you and they may say, hey, John, can you co-sign for me? I know you have excellent credit. I really need some help. Can you co-sign for me? It's no big deal. I'm going to be making the payments. Is that okay to do? Are you all cool with doing that? Let me know. Somebody said no. Very good. No. I see all these answers coming in. I guess if you all haven't learned anything else from us, you all have learned not to co-sign on anything anymore. Great job, everyone. Absolutely not. I see it. No, thank you. That's what you tell them. No, thank you. I'm trying to do some things financially for myself and my family, and I can't afford to pay your bill and my bill. So I'm going to just pass on that one right now. Okay. Very good, everyone. You are responsible. When you co-sign for someone, you're responsible for that debt as well. And especially when you're going through the home buying process, that can be a big hindrance and cause you, to not qualify. So those things you just don't do. I know it gets hard. We all want to help our family. We want to help our children, but it's just some things that you just cannot do until you are well established yourself and you can say, hey, I can afford to make this extra car payment if my son or my daughter does not make this payment. So just some things to think about. Thank you all for participating in that. Thank you. Next slide. Okay, let's talk about non-traditional or alternative credit. Alternative credit can sometimes be used by lenders when there's a lack of sufficient credit history. So most lenders, they want to see that you're able to handle credit, but they also want to see that you may have 3 or more trade lines. 3 is always a good number to have. And when I say trade lines, I'm talking about credit cards, student loans, auto loans, something that you're paying on monthly that's reporting to the credit bureau. And alternative trade lines can be used. So say I pull your credit report and I see that John Doe only has 2 trade lines and can handle them very well. Monthly payments are not that high. And I tell John, I said, John, we need to have another trade line. So instead of me telling him to go out and maybe try to get some more credit somewhere, I'm going to ask him first and foremost about, do you have any alternative credit that we could possibly use? Some of those options include, like below, rental payments, okay? Or if you've been leasing, and it has to be for like a year that you've been leasing or renting your apartment, it's in your name, and all payments have been made on time, okay? If that's the case, then a lender can use that as an alternative trade line or non-traditional credit. It's basically stuff that doesn't normally get reported to your credit bureaus. Utility payments, those normally don't get reported unless you default or in collections or something. Child care or child support payments. Gym memberships can be a form of alternative credit. Cable, Netflix subscriptions. So we all typically have some form of non-traditional credit that we can use. Just things to keep in mind. Usually you have to have had it for 1 year. It has to be in your name, and you have to have made all payments on time. If so, more than likely the lender can use it as a non-traditional or alternative credit. Okay. Establishing credit. Healthy ways to establish credit. First and foremost, pay bills on time. And I know you all remember Christian, when he first started off, he talked about, the biggest part of your credit score, paying your payment history, 35% of your score. So it's very, very important that you pay on time. And this is kind of like when you're getting into that 30-day, anything past that 30 days. If it's before that, normally they don't, hit a credit report. It won't hit a credit report until you get to that 30-day. When you get to that 30, 60, 90-day late, this is really going to hurt you all. So don't do those things, okay? If something comes up and life happens to everyone and you know that you're not going to be able to pay that bill on time, just communicate with your creditor. 9 times out of 10, they're willing to wait, or do what they can to assist you, whether that's you paying a smaller amount and then in a couple of weeks paying the remaining amount. But you have to open your mouth and you got to communicate, because you don't want it to get on that credit report and be reported as 30-day late. Okay, so make sure you pay your bills on time. You can open a checking or savings account. These are good ways to establish credit. You can apply for a loan using your savings as collateral. And because the loan is secured by your savings account, some banks will sidestep you filling out the application, and you can mostly get approved immediately through your bank. So this is a great way to establish credit, using your savings as collateral. You can also apply for a secured credit card. A secured credit card is a card that requires a cash deposit when you open the account. The deposit reduces the risk to the credit card issuer, and they're just much more prone to, giving you a card that way. This is just to get started. Once you get established, maybe 6 months out down the line, if you've been using the card, they may allow you to go ahead and apply for an unsecured credit card. It just depends on how you handle the secured credit card. So very important. And Porfirio has been hitting on this. Do not open any new credit accounts during the mortgage application process. Now, if you're working with a counselor and they say, hey, we need to do something like that, that's okay. But you all have that discussion. But do not do that before speaking with your counselor, okay? It's very important. No new credit accounts during the mortgage application process, because you trust and believe that lender is going to pull that credit before you go to closing. And if something new on there, and those payments affect your debt to income ratio, guess what? You're not getting that beautiful brand new house that you've been waiting on all this time. Okay. Some tips for improving your credit score. You can go get a copy of a weekly copy of your Experian, Equifax, and TransUnion credit report. So if you see any incorrect information in there, make sure you correct it. Correct inaccurate information. These things are ways that can help improve your credit score. And consistently pay your bills on time. Just get in your mind, never late, never late. And we have our smartphones and things. You can put dates and stuff in your calendars. It's gonna pop up. So, I mean, it makes it so easy. Nowadays, it's just so easy. You have so much technology to remember that the bills are due. So consistently pay your bills on time. Keep your overall debt at a reasonable level relative to your income. And this is just like, say you have a credit card and the credit card is $500, okay? With that credit card being $500, that means on a monthly basis, you should not put no more than $150 on there to be under 30%, okay? Because if you're over that 30% utilization, guess what? It's gonna ding the credit score. Our goal is to improve the credit score, so keep it under that 30, okay? And then if you can, just pay it in full every month. If you can't pay it in full, at least pay the minimum by the due date, okay? Manage your credit accounts responsibly. If you run into any trouble, you're gonna have to pick up that phone and call your creditor and let them know this has happened. People, they know life has happened to them too, so they understand. So never be afraid of picking up the phone and calling them, but you gotta be responsible with these credit accounts once you get your foot in the door and you have some credit cards and things of that nature. All right, so that's the end of our slide. I'm hoping we have some questions in here because again, I know you all are very interested in this topic and we are here to answer those questions. Porfirio and Christian, you guys want to join me?
Yes, ma'am. And don't be shy. You guys don't have to all ask questions at once.
And we understand as well, if you're working with one of us and you want to wait and, ask it one-on-one, that's fine too. But feel free. The same question you're wanting to answer to, a lot of other people on here, I want to answer to that same question.
No, yeah, Rita, and I kind of wanted to piggyback off what you were talking about, the annual credit reports. I know I saw a comment. Due to the pandemic, we currently are able to get it once a week. Last time I checked, they had pushed they've been pushing it back because of COVID every other month. And I think they have pushed it back now into at least April. So, definitely that's something I highly recommend. If you're having any type of discrepancies and you're reaching out to the credit bureaus, you go and get your credit report, at least once a week. Because yeah, it looks like right now they still currently have you can still get your report from all three bureaus, and that's amazing because before the pandemic, you were only able to get it one time from all three credit bureaus a year, right? And so one of the hacks that I told a lot of my clients is like, hey, if this happens again, get TransUnion the first quarter or the first 4 months of the year, and then get the TransUnion the second 4 months, and then Equifax the last 4. So that way you're kind of making sure that there's no fraud being committed or anything like that. But that's a nice gem there.
Yes, it is.
So I know we have one. How can I fix a negative charge off on my account? I'll let you take over on that one, Ms. Rita.
Negative charge off. First and foremost, I know a lot of times, and I know a lot of you probably are watching YouTube and stuff. It just depends on the situation and it depends on how old the account is. Again, with Dallas Habitat, we're looking at the last 3 years on the account. So if that account is 3 years or younger, then you're going to want to go ahead and take care of that account. Now, that's not the case. I don't tell everybody to go ahead and do that. It's an individual basis, and it depends on what you're actually trying to do. If you're trying to get a home with Dallas Habitat, you need to try to resolve that negative account, okay? Whether that's getting on a payment plan, if you can afford to pay it in full, you can do that. But if it's closer to that 3-year mark, I would say you want to try to negotiate. Now, if it's a younger one, like a year old or something, they may not be trying to negotiate with you because it's a fairly new account. But the older it is, the more that they should be willing to negotiate with you and get that resolved. And I hope that answered your question. And Porfirio and Christian, please feel free to add if you all would like to. Good question.
Hey, Aretha, Porfirio's audio, I don't think is working.
Okay.
Just so y'all are aware. I know we can see his face. He's having some audio issues. Aretha, I thought it might be important to kind of follow up to that question too on charge-offs, because we get a lot of questions I know about, do I have to resolve a charge-off, or by an account being charged off, is it already essentially resolved? Do you want to speak to that a little bit in regard to qualifying for a mortgage?
If it's charged off, again, we're looking at the date that it was charged off or it was closed. Again, with Dallas Habitat, if it's 3 years or younger, you're going to need to try to go ahead and resolve that. I know some, if you're buying on the open market, that may not be the case all the time. So I suggest a lot of times to people, if it's something right there on that 3-year mark, I'll tell you, hey, let's just wait to see what they're going to say. If it's not a big amount, something I know that you can resolve fairly quickly. Say maybe $150, $200. I'm not going to tell you to go and take care of that if I know you're buying on the open market, but just going by our underwriting guidelines, if it's within that, if it's charged off and it's 3 years or younger, you know, at that date. So say 2020, we're in 2022. If the charge off date is 2000, it was charged off in 2020. I'm going to say, hey, you need to go resolve that. Whether that's like I said, negotiating. I don't care what you pay, what you resolve it for. If it's a debt that's $200 and you pay $50 and they were okay with that, that's fine. Just have your letter, you know, stating that it's been resolved, or it should be updated on the credit report that, hey, settled, paid as agreed, something like that.
Yeah. And what I agree, Aretha, and I add on to it, like, you know, that's why it's important to check your credit report, right? Because that way you can tell, okay, how long I've had it, right? Because you might have thought that you're 4 years out. So, you know, now in the 3-year mark. But if they charge it off or they sold it off to another, you know, a credit agency or a collection agency, you know, it can refresh it. So that can be, you know, some of those, one of those federal laws that we have that, you know, protect us, you know, to help you. So, you know, I also will recommend, depending on what the status is of the account, you know, the payment history, or, you know, if it's hurting you, you know, depending on how far it is, you know, you mentioned as a lot of my clients pay to delete, right? You can definitely negotiate. At this point, the damage is done. Mm-hmm. So you can work it out and say, hey, I'm not willing to pay the whole amount because, you know, you're not even the creditor, you're the person that bought it. So most of the time they pay pennies on a dollar. So it's good to kind of negotiate. And that way, you know, you say, hey, I'm willing to negotiate. Can you make sure, you know, if I do that, can you go ahead and make sure you guys delete on my record? Because actually will ultimately help their credit score and boost it. And that's what we want at the end of the day, is to boost that credit score. But just to kind of let them know, hey, you do have options, you know, so just be aware about that.
Yes. So. And if you're not sure, just wait until you meet with your counselor, because we're going to go over that credit report and we're going to review those dates and things with, you know, regarding charge offs. And we're going to let you know, hey, if we think it should be resolved or not.
That's great advice, y'all. Thank you so much. And I see a question in the Q&A from Caprice, who's asking a related question to that. So what if you have potentially a charge off that's showing on your credit report that's, in this example, 6 years old, but the company either went out of business or they're refusing to remove it from your credit report? Do you have a right to be able to fight that in a different way?
She said about 6 years old.
That's right. Uh-huh.
Well, typically it's going to fall off. It should be off of there in 7 years. If it's showing up on there 7 years is the standard date outside of a bankruptcy. A bankruptcy is 10 years, so it'll probably show for the full 10 years, and any other debt 7 years. But 6 years, I wouldn't say mess with that. You know, with Dallas Habitat, we wouldn't, depending on what it is. So if it's electricity, you know, something dealing with that, or, you know, water, something where you're going to have to possibly put down a deposit. Now, we may tell you to go and try to get as much information as you can, maybe a letter from them. If you're having a hard time, especially if it's something that the company is sold, you can't find any information on there. We may have to do a LOE, a letter of explanation, explaining what's going on. And the lender's kind of lenient to that kind of stuff. So yeah, that 6 years old, I wouldn't worry about that too much.
Thanks, Aretha. And I think, you know, Christian made this point earlier, but sometimes when you fiddle with some of the stuff that's on your credit report that's that old, sometimes it can that activity can stir things up in a way that might work against you. So to Aretha's point, sometimes it's better to ride that out the longer it's been. Yes. Here's the last question. Oh, I'm sorry, Aretha.
No, I was just saying to start that clock ticking over again, and when it's getting ready to, you know, fall off in another year. So yeah, that kind of stuff I just wouldn't worry about too much.
Great advice. Great advice. Here's the last question that I think that we've had come through. The question is, if there's a couple that's applying jointly and one of them has a low credit score, does that disqualify both applicants from being able to purchase a house?
No, it doesn't disqualify you all. As counselors, our goal is to help you increase your score. So if one of you all come in and that one has an excellent score and the other one doesn't have such a good score, or maybe doesn't have a score at all. My job and Christian's job and Porfirio's job as counselors is to help the other one establish credit, you know. It's just always a good idea to have both borrowers have good credit. You just never know what's going to happen down the line. You know, I know there are, and this is without getting into the weeds. There are sometimes where you can apply for a mortgage loan and not have use the spouse's credit. They would definitely be on the loan, you know, on the deed, but they wouldn't use their credit. So that's, like I said, I don't want to get too far in the weeds with that. But as counselors, our job is to make sure that you have a good score, both of you. So we're going to work toward that goal of making sure both of you have, and we have ways of getting that done and getting it done fairly quickly. So yes, but it won't cause you to be denied. There may be some things that we have to work on. It may take you a little bit longer than what you thought. And then maybe not, it may not take you as long, you know, as you're thinking anyway. So, but yeah, definitely, as I put my counselor hat on, I would say that we will work on making sure both of you all have good credit scores.
Yeah, Blaney, to enter and to kind of piggyback off what Ms. Aretha's mentioning, I think it just depends on the situation, right? Also, it can be, they might think they have bad credit, but they might be decent. So until we kind of see what's going on and analyze the situation, we can come and give a better detail. And it might be where, hey, you know, lenders might not give you the best rate, or they might not approve you, but that's not a hard no, never going to happen. It means, hey, well, let's work on a few things we need to work on. You know, let's see what you need to work on. We'll see where we can improve it. Maybe add, you know, if it's a couple, add the person that has more credit, has good credit, add them to that as authorized user, whatever the case might be, move stuff around, and then we'll go from there. But again, at the end of the day, it just depends on, you know, if they're doing co-applicants because they want to have a higher loan amount. You know, if you're not looking for a house in the 200-300 range and one person's income can afford the loan, then you might not even you don't even add the co-applicant, you know. But of course, in Texas, you know, common law state, you would definitely be on the title because they are married. So just, we want to be aware that the situation just depends on what the lifestyle is for sure.
I believe that's all of our questions.
Awesome. Well, I know we really have enjoyed discussing this webinar with you all. Again, credit is so important. It's important to try to, do your best, to establish credit and to keep a good credit score. But at the end of the day, we know life happens and we don't want you all beating yourself up. Just do the best that you can. We've given you the tips and things that you need to know in order to have a good credit score. So just use these examples and things that we've taught you tonight. And as you're going through the counseling program, we're constantly having classes and we're talking about credit and ways you can improve your score. Just do all these things and take it one day at a time, and you're going to be a pro at keeping that credit score at a certain level. So if it's not where it needs to be tonight, do not worry about it. One day at a time, we'll get there. Okay. And we thank you all so much for joining us this evening. On behalf of the homeowner services team, we appreciate you all. And we have, please do not forget, we have a couple of classes coming up in March. Get off right now, tonight, and go and register for those classes. Again, education is a requirement of the program. That's how you're going to make sure you get in that house and be a savvy consumer and be able to stay in that house. Our goal is not just to put you into a home, but to make sure that you can stay in that home at the end of the day. So be sure to come to the classes and get all the education that you possibly can. You can never have too much. And I'm going to pass it to Christian so he can wrap it up.
I just want to say thank you guys so much. Again, people that are joining through Facebook Live, or all the friends, family that are not in the counseling program, definitely reach out if you guys have any questions, and get some research of what we do. I definitely applaud you guys for all being here. After Tuesday evening, a long day. I would want to say you guys stay warm, stay safe, and enjoy the cold front that's coming. You guys have a great evening.
All right. Bye-bye, everybody.